Yeah, hi everyone. My name's PK, and here I'm very grateful to have Vineet Dunwar, who is a mortgage broker. He's got a lot of experience. I'll introduce him in a second, but I'm really excited to do this episode because we're going to be covering five essential ways every property investor should improve their borrowing capacity. Okay, it's interest rates are higher than what they used to be 2 or 3 years ago, although not really super high compared to long-term averages. But for those of you who are in the market now, you're really wanting to expand your portfolio, start your portfolio, but you're like, PK, like, how do all your clients get all these properties? How do all these other people get all these properties? I can't even borrow one, or I can't even borrow two. Like, I'm a normal person, but how's everyone else doing it? Well, this is the episode for you because we'll go through five ways, and these aren't like silly ways. I shouldn't use the word silly because a lot of times when you go to a mortgage broker and you ask, how can I improve my borrowing capacity? They're like, oh, PK, try to earn more income. And it's like, come on, like, thanks for that advice, but I appreciate it. But, like I'm already working two jobs or whatever the case may be. So this is not that kind of episode. We're very fortunate to have Vineet because he is a chartered accountant by profession, but he's been 20 years mortgage brokers, company that he works with Blue Hive, they're really experienced. They know the lending ecosystem inside out in Australia. And we're going to be going into technical things, not the sort of stuff that you just can Google and find out. So this will be really interesting. I don't want to spoil it, but the five things that we'll go through very, very quickly is how to set up the right entity structure to maximize your borrowing capacity, how to recalibrate your existing loans, how to use household expenditure measures to for existing loans, the HEM, how to find the best lending policy for your situation, interest only versus principal interest loans. And then if we get time at the end, Vineet might go into even some more curious things like for your principal place of residence, should you buy in a trust, which I think basically no one considers. Anyway, I'm hogging the mic and I'm not the expert on the subject. Vineet is. So thank you so much, Vineet, for making time and coming on.
Thanks, PK. Thanks for having us here. And we will try and explain as much as we know around the ecosystem and how best to leverage that for the clients, especially those who are on the investment journey. And like you said, there are five very critical ways where, if correctly deployed, can significantly improve the borrowing capacity for the investors. And it's pretty much like the analogy of health. It's like if you prevent health, you live longer, you live healthy. But if you've exhausted yourself, it's very difficult to retain that health and that vigor again. So I think that's where this particular episode and my kind of trying to drive value for your client is really, really helpful. So I think the first point first, like you said, what should be the ideal structure, and what should be the timing around it, right? So I think one thing with absolute responsibility we would say is these are answers to difficult problems, but these have to be specific to every family situation. So what we are talking is more generalist, but different family income groups would have different outcomes, and that's where the unique lens would come in when we have but a good structure for a mid-income family group, it's pretty much like working on your health for a long-term basis. If you are in the right structure, and right structure very responsibly has to be right from setting up. So for example, a lot of people use trust as a jargon, but then there are 100 ways you can set up a trust, but banks only like a fair few. So you need to know what's the specific structure that flies within the lending ecosystem as a start. So getting the right structure is your first start. And the more you are in that mid income and low income group, the more critical it is. The industry try to talk you the other way around, the trust are for the riches. It's actually not, because riches are where they want to use negative gearing to offset their taxes. It's the mid-income group like us, the most of the Australian community, where getting into the right structure right at the start of the game helps you preserve your borrowing, because it's very easy for most families to exhaust their borrowing just after two or three purchases.
And just so people can resonate with this and relate to it, when you say mid-income bracket or mid-income group, what are we talking here? What's the range in terms of household income?
I think Household income, husband, wife working with two dependents, we are talking 250K to about 400K is the mid-income group. Anything lower than that is also kind of covered here because it becomes super critical for them.
Okay.
Anything upwards of half a mil is where they are high income earners. Their borrowing capacity is immense. You can actually afford to buy few in your name and still not exhaust your borrowing.
Hmm.
So on the more you are on the lower side of the spectrum, the more critical is to be in this structure.
Right, right. So when you say mid, people might think that's 150, but your definition of mid is actually 250 to 500. But it's very interesting. You're saying actually the lower your income, the more critical it becomes, which is, yeah, I don't want to ruin your stream of thought, but just as my thought process, it's like, well, trusts are expensive to set up. There's compliance fees, there's audit fees, tax fees. So it's like, oh, if I'm only earning 100K, like this is whole burden. But actually, you're saying that's where it's even more imperative to go towards a trust structure.
It's actually counterintuitive, but it is. And if I just go into the level of the cost versus the benefits, right? Because we're talking very critical stuff here. Like setting up a trust could cost you in that range of $2,000. It's a one-time cost. And then the annual maintenance cost of a trust is about $1,000 roughly with one property. And it kind of goes up with every subsequent buy. Now, imagine this $2,000 setup cost one time for about 3 to 4 properties that you can buy in one single trust. And that's the complexity we will talk about. But if you are able to preserve your borrowing and instead of just being able to max out at three, this structure is able to help you buy 6 or 9 properties, of course, subject to a lot of income generating abilities. That cost in absolute terms is insignificant to the wealth creation opportunities the right structure will open up. So it's absolute cost versus the potential of wealth creation in the right structure. So costs are actually insignificant if you are in the right ecosystem.
Yeah, sure. All right, please go ahead. How do we actually expand our borrowing capacity within trust?
Yep. So I think with the trust, you expand in the sense you reserve your borrowing capacity. So everything, so think like this, everything that you buy in your name or in your family name as husband, wife, couple, it consumes your borrowing. And banks cannot ignore what's appearing on your credit reports. However, in the legal parlance, trust is a separate entity to individuals. So when you borrow in a trust, it is seen you are seen as a guarantor and not as a principal borrower. Now here's where the ecosystem and the complexity starts opening up, and that's where the game starts. Now a lot of lenders who would see a corporate entity distinct to individuals would say, hey, do we know this particular entity is self-sufficient? That's where your accountant, based on the numbers of the trust and a macro view of your financial income, should be able to support you. As long as your properties are neutral to positive, and even if they're negative to that extent, there are ways and mechanisms to feed into the trust so that they become neutral. So there are legal ways to be very legit in the process and still be able to go back to the bank and say, hey man, yes, we have this entity, but this is self-sufficient, and ignore this for your calculations.
Right, right. Because I mean, I don't think it's a new concept. This concept, and maybe you're going to expand upon it in a minute or two. It's not alien to some investors that, you buy one property in a separate trust every time, and as long as it pays for itself, then, it doesn't, or it preserves your borrowing capacity for each subsequent property. You can, set up a separate trust and keep going like that. But generally, it needs to be self-sufficient. Like you said, that each trust needs to pay for itself. This concept that you're talking about, where even if it's costing you money, there are some legal ways by which you can still have banks disregard that debt. I think it's a very important point. If you don't mind just expanding upon it for a second, because with the current level of interest rates, even at, let's say, 80% LVR or 80% deposit level, it is quite difficult, right, to get properties that pay for themselves. Certainly in Melbourne, Sydney, Brisbane, you can't really do it. So, if they're costing, I don't know, a few thousand a year, 5,000 a year, whatever the case is, let's say in regional Australia, other capital cities, how is it? And feel free to let me know if you can't talk about it or whatever, but how do we tell the banks or how do we allow the banks to realize that it is still self-sufficient?
Yep. Yep. So I think first thing first, PK, you don't have to have one property per trust. You can actually have multiple properties. So that actually helps you optimize. Now that multiple would is driven by the income and the bank policies. Like it's a complex subject. So most lenders who are very pro trust can allow you up to 4 or 5 properties in a trust, subject to your income. So as long as your family income is able to sustain service the four properties, you can have one. So you actually optimize your admin cost, you optimize your setting up cost. Now imagine you are about $10,000 short or negative in your a particular trust portfolio on an annual basis. As guarantors, you are able to fund that trust with that deficit. And that trust, by taking your contribution from the guarantors, becomes self-sufficient to neutral. From an accountant's point of view, as long as trust has enough funds to pay for its liabilities, it becomes a self-sufficient entity in itself, in its own right. And that's where accountant can certify that trust is able to look after its liabilities, it's self-sufficient and able to service its debt on time or as and when arises. Different lenders have different languages, but common understanding is yes, if it is self-sustainable, we don't have to worry about it. And more so, it becomes more critical if we are not relying on the income of the trust, and which is typically not the case in this current scenario. In the pre under 2% kind of scenarios, we were able to use the income from the trust to boost up your borrowing. But right now, it's the other way around. Investing properties is actually consuming your borrowing. So this structure with a loan or a deficit being supported by the guarantors would help you take it off from the calculations for your next borrowing.
Right.
However, when I talk about this, as long as you are in the same structure, every borrowing has to be considered. So if you're buying 3 properties in that trust, everything will be calculated for that particular trust. When you go to trust B, we can ignore trust A. So from a bank's point of view, you just have one PPOR in your name, and this is a new entity, entity B. So entity E is kind of completely ignored from the calculations.
Right. Makes sense. And does it, is it important or is it vital to set up these trusts, whether it's one trust for a number of properties or then another trust for a number of properties, before you do any investing at all? Or for folks who are listening and maybe they've already got 2 properties in their personal names or their wife or whatever. Maybe they have a kind of a sneaky trust, which they don't really know how to use properly. And they're kind of maxed out and they're like, wow, structuring is a bit messy. Like, what do you do in that situation?
Yep. So our recommendation is you should be in the structure right from your first investment properties. But most investors don't realize the importance of this structure, and they think let's take couple and then we'll think about the structures. But the structure is about preserving your borrowing. It does not open up anything new. So
Yeah.
if you have exhausted yourself, then no matter what you set up, no structure is going to help you. So a prudent advice is to think about this structure right at the start of your investment journey.
Right.
And it's a topic of conversation because, like I said, based on the family income, we can time the structures. If you are on that high income family, then you don't have to worry about the structure for a couple, and depends on what are you buying. If you're buying something in Brighton for 3 mil 4 mil, you would consume yourself again.
Mhm. Makes sense. Makes sense. And so for someone who hasn't considered this from the start and they're like, well, I have actually maxed out my borrowing capacity based on my income, is the only way to reset or to take the next step to undergo the sort of costly exercise of perhaps selling those properties into a new trust that they set up. You get pinged with the stamp duty, and then being able to continue. Like, have you seen your clients do that? Is that something you recommend?
No. So I think for all our clients, selling anything of the portfolio has to be the something solution of a last resort, or if we realize the property itself is not performing.
Mhm.
However, there are a number of ways that you can, especially someone who has been in the investment journey for a while. For example, there are clients who come to us who've been in the investment journey for 10, 15 years. So we'll take a holistic view of their existing portfolio, and we realize some of their debts have been set up 10, 15 years back. So their remaining term is all about 12 years, for example. In those cases, we actually help them reset again. So we reset new loans for next 30 years. So that helps us, in very critical ways. For example, it helps us, one, use the current valuation of the property to optimize the borrowing. We also extend the term of the loan, which again optimizes your borrowing. So you actually, and if you are almost 10, 12 years in your PPOR journey, we're actually able to convert that debt into an investment debt. So it actually gives you the negative gearing advantage also. Like, I'm telling you a lot of magic wands that goes in the ecosystem, but people don't realize. But yes, recalibrating your portfolio, especially if you have been in the journey for 10 odd years, is a very good way to reset, and it will open up, it does open up for, we have clients who come to us with kind of almost exhausted with a few $1 million kind of portfolio, and just by resetting and looking the getting it to the right lenders opens up about another $1 million kind of borrowing capacity. And people don't realize that ecosystem lending ecosystem kind of continuously evolves. So the policies that were relevant 10 years back have changed significantly. So banks take a very different view of you based on your income group, age group, the asset value, and we can use the best policies for you at this point in time to reset. So that recalibration can open up. So yeah.
Right. So what were the, and this is point two. We've kind of gone to point two. I do want to come back to point one. I just have one or two questions more, but what were the
Yeah.
main items that you just mentioned that people should consider, go to their broker or whoever they deal with in terms of the second point of how to improve borrowing capacity, recalibrate your existing loans? So you mentioned one, which is where, let's say you've got 12 years left on your loan, you stretch it out back to 30 years. I don't know what the technical name for that is, but what were the other ones that you just mentioned?
You could convert your PPO or debt into investment debt. And the reason is because you can actually explain, my PPOR is kind of paid off. I'm using that property as a security to use for investment purposes. And that could help you maximize or optimize is the right word for borrowing, because how the banks calculate investment debt versus PPOR debt, the calculators give you a different outcome.
So are you talking about debt recycling here? Are you talking about some way where you justify to the bank that my entire PPOR loan is actually, funding as a security, it's
You
funding my
explain to them.
investments?
I think you explain to them, you tell them the logic of what you're trying to set up for the client and how the funds are going to be used. But like I said, debt recycling is kind of is a topic that is part of this whole conversation. It's nothing out of this. It's not a it's not a different strategy. It's kind of part of this whole thing we are trying to do is use your existing portfolio and the current valuations and the lending ecosystem to boost your borrowing overall. So it's a holistic view of doing things.
Right. So under the banner of recalibrating existing loans, they're stretching out the loan term. And of course, because you amortize those, the principal repayments over a longer period of time, therefore the cash flow position improves, serviceability calculators are benefited. There's the debt recycling or converting PPR debt into investment debt, making it deductible. And because the banks perceive investment debt with a different light, that, perhaps increases your borrowing capacity. What other items fall under this banner of recalibrating existing loans?
I think this would be the two key ones, and then you have things like P and I versus interest only. You would have heard a lot of people. But again, that's depending on every family situation. Like P&I is one of our most recommended approach because it helps you pay your debt with every installment.
Hmm.
However, if you are in a situation where you pretty much have no savings left and you want to accumulate cash over next 12 months or 24 months, then we recommend you go IO path, interest only. But interest only does consume your borrowing more than the principal and interest. And it's not in an investor's favor or for a long-term basis because your debt kind of stays constant. It's not reducing on a consistent basis with every installment you pay.
Yeah.
So it's a short-term strategy to boost your cash savings for your subsequent buy. So again, reset again after 2 years. Once you have enough cash for the next deposit, you use it. But more often than not, because we recalibrate and we use the valuations, you're able to use the equity out of your current portfolio itself to fund your next one. And it's actually, we take you to almost 100 or 105 kind of borrowing
Hmm.
because we are using the debt for the deposit and we are using 80 or 90%. And as a matter of fact, because you use the technique to recalibrate, it actually helps you bring down the pricing. So you don't have to worry about going to tier 2, tier 3 when you can stay within the tier 1 with better pricing.
Right, right. And I guess obviously this depends on a person's real household cash flow budgeting as well, because if you're going to 100%, 105% debt, then obviously your loan is larger, your interest repayments are larger, and then if you couple that with, let's say three properties on principal and interest, then all of a sudden, people are like, well, I can't afford that, right? Let alone one on
Absolutely.
principal and interest. So I think these are all very valid points, and people should think about them in the context of their own unique financial situation. Because I know myself, like if I did principal and interest from the start, I just wouldn't be where I am today because I wouldn't have been able to afford all those
Yes.
properties. Whereas I did IO the whole time and rolled them over. And back when I started, you could call Commonwealth Bank and they would roll over the interest only period, like with a phone call. Now you have to refinance it, but I've refinanced it multiple times, and that's just preserved my household budget cash flow. And then you could use those surplus funds to fund, like you said, subsequent deposits. And like I think it's interest only as a strategy, as a generalization for those who are aggressively wanting to build their portfolio because they're bought in. They're sort of, doubling down on property as the vehicle for their wealth creation, which is what I did, and everyone should do what they're comfortable with. But I think that's a really good point. I know we're jumping around a bit here, Vineet, but back to the first borrowing capacity topic we talked about, which was trust.
Yes.
I just want to solidify this in people's minds. Is
Yep.
there like a client example? I mean, you can rename them Joe Blog, but could you take us through like a real life example of where a client, was would have been maxed out if they had not bought under trust, but they went on to buy, I don't know, four, five, six, seven,
Yep.
eight, nine properties?
Yep. So I actually have a client, and we have a few clients, not one, but I have a client from your community also, and he came to me when they only had a PPOR and they wanted to start on the investment journey. And he said, "How much can I borrow?" I said, "You can borrow 1.2 mil." And he's like, "But I want 10 properties. I've
Okay.
come from PK's course. I want 10 properties."
Yeah,
I
sure.
said, "You can't, Matt. Just divide 1.2 by 10 and it's 1.2. Can you buy something in 1.2?" And he's like, "No." I said, "What's your average purchase price?" He said, "Somewhere between 4 to 5." I said, "Let's start conservative. You are able to buy something at 400K. All that you can buy is 1.2 mil. So three properties and you max out." And this is a family income of 250K kind of a number that we're talking about. So I'm not talking about high income earner or a very low income earner, mid segment, 250K husband wife. And then we kind of negotiated and discussed how a structure could help you. And we went through the whole education process, the modeling. We did the modeling for them, and we actually helped them set up the structure. So at this point, they have three properties plus a PPOR, and the three investment properties are bought in a structure. And coming next financial year, we can again buy three more. So from maxing out to three for your life, We are using the next financial year, July onwards, to buy three more. So the I think the premise or the base assumption here is you are able to preserve your income generation ability. So as long as you are on the same family income, we will have this structure in place. We have the ecosystem around you, and we'll let you keep buying as long as the cash flow of the family is there. So we are very conscious of responsible lending. So we are not trying to maximize and throw people under the debt. So we are very, very conscious. So hence the advice has to be specific to every family situation. But this is a classic example where we actually help a client not just max out at three, but create the ability to continue to use these structures for your subsequent purchases.
Right. So they had their principal place before. If they just bought under their own names, they would have been able to buy up to 1.2 million. So that's like three properties at 400K each. They went off and got $1.2 million worth of property under a trust, three property at 400K. But now, because they bought it under trust, that entire 1.2 is preserved still.
Reserve.
And so then next year, they can buy another three, let's say at 400 each, in a different trust. And then I know there's responsible lending and all that. But where's the cap to this? Like in the subsequent year, could they go off and set up a third trust and buy another three, another three? Like where does it end?
So as long as your family income supports the cash deficit, like you said, so we know in this high interest rate environment, every property is negatively geared.
Hmm.
So as long as you are able to create enough savings to fund
Right,
your deficits, you are able to use this process. So
right,
the cap is when your family income plus your rental income is not able to support you for subsequent funding of deficits.
right.
But that's a long way drawn in comparison to if you start buying everything under your name.
I
So
understand. I
yeah.
understand. And so, like what I'm seeing with my clients, and I'm sure lots of people who are buying well are seeing this, where, right now you buy a property. Let's say 2 years ago, 2022, end of 2022, let's say you bought in Perth somewhere, interest rates had gone up however many times in the year 2022, and that property was maybe like two to three to four to $5,000 negatively geared, negative cash
Mhm.
flow. Fast forward 2 years, now we're in 2024, the rents have gone up like 20, 30%. And so even though interest rates have gone up, the rents have gone up so much as well, let's say on an 80% LVR, 88% LVR, that now those properties, they're not so heavily negatively geared. And
Correct.
then fast forward another 12 months, even though right now they're neutral or just a bit negative, they become positive. So
Yes.
once again, I'm trying to, because I think these are the questions that will be on everyone's mind as they listen or watch this in 2 years' time, when all those properties become positive, and like you said, the real, tangible, material cash flows for the household in this client's example is now neutral or positive again from their portfolio. Does that mean they can now create a fourth trust and buy
Yes.
another three and a fifth trust and then another three? So you got like five trusts times three, 15 property. Like, th- do you know what I'm trying to get at? It seems like too
Yes.
good to be true. And of course, you have to be responsible and
Yes.
everything like that. But is there any cap to this or is there no cap?
There is no cap. The cap is, remember, you have to play in the lending ecosystem, and what lenders see they cannot unsee. So you have to be really protective about your structures. So you cannot shop around with a structure to the lenders, and that's where we come in. We preserve the conversation. We tell what they need to know. You tell everything, and that's it. So, like I said, it's a combination of the right structure, right lender, and what you tell them. And
Right.
that's where it becomes a complex subject. You can have n number of documents called trust, but if they're not the right structure, you won't fly with the banks. You may have the right structure, but you go to a wrong lender, you would still max out because they hit your borrowing or credit score. So it has to be a combination of all. The right lending policy has to support. And like I said, absolutely responsibly, not every lender is pro trust, and they take a different view. So you have to pick up and find the lender who is pro investment, pro lender at that point in time. So lender A, for example, is aggressive today, does not necessarily mean 12 months later they would have the same aggression towards investment properties.
So
It
what
will work.
happens then at 12 months time? from now, Vineet, if you've doubled down with lender A, and then 12 months time, their bank policies change, their net interest margins change, and now they're not so favorable towards investors. Does that mean you need to refinance everything to a different
No,
lender?
actually not. So because your current portfolio is stays neutral to positive, like we've discussed, so you find the new lender for the new structure.
Hmm.
That's how it is. So you don't take the whole setup to the new lender. You don't. That's the biggest mistake you would do. You need to really preserve your conversation with the lenders. They need to know, and we are absolutely responsible in this conversation. It's not required to tell them more than what they need to know as per their policies.
Right, right. I think it's an important point. Like, this is nothing that you're saying is like dodgy stuff. This is not
No,
sketchy business. This is all straight and narrow down the line, all very legit and legal. But it's a case of understanding how you can play the game. We're not going around the border or the perimeter of the game, but we're just playing the game in the way that it's intended to be played. And I don't know if it's a trade secret or whatever, Vinny, and you don't have to tell me, but like, what are the lenders right now that are quite favorable towards this approach?
do you want me to name the lenders if you
If you
may?
want, yeah.
I would not. I would refrain
Okay.
just because, not because of the community, but
Yeah.
because of the lenders themselves.
Okay. Okay.
So
But these are
yeah,
like tier one lenders, right? You're talking about?
tier one, tier two. Yep,
Yeah.
yep, yep.
All right, all right. Cool. No, this is very, very interesting. And I think a lot of people will be listening right now or watching thinking, I wish I knew this before I bought my first property, before I bought my second property, because now I'm already capped out. For people like that, what should they be doing right now?
I think what's missed is missed, but you still have a lot that can be done around recalibrating. And if we are able to open up something for you, at least preserve that bit by getting into the right structures. So it's never too late. You might still have 600K or $1 million left despite all your previous mistakes, but you can actually preserve that bit and use that fast forward. And as you kind of optimize your property portfolio, some properties have come to fruition because they have done the capital growth and you have to drop them. So as and when you drop your existing portfolio, the new acquisitions then come in the right structures. So you keep correcting over the years, and then eventually you would have a very calibrated portfolio under the right structures.
Right, right. And look, I'm the same as you. I think the transaction costs of buying and selling property in Australia are very cost prohibitive in terms of, just whimsically selling. Selling is something that should be thought about twice, three times, four times before you pull the trigger. But maybe there are folks out there that truly do have quote unquote dud properties or properties that have run their journey, run their course, and if they're in that situation and they're currently maxed out, then perhaps with the right team around you, with the right data, with the right mentors, you could consider selling and then embedding yourself in this.
Yes.
This is like you're trying to get out of the atmospheric pressure of lending, of the current lending environment. Try to escape the Earth's atmosphere, and then you can really build your portfolio is a way that I think about it. Is there anything else that you want to say around like lending policies or different or best lending policies in 2024?
I think lending policy is a very, very crucial subject, like I said, right from, and we have been talking about lending policies in some shape and form for last 30 minutes. If you realize, like I said, the structure could be right, but if the lender is not right, you are still stuck. So lending policy would come into play at every bit, right from who is happy to accept the structure that you are proposing, that's where it is. But then after that, lending policies could be specific to your circumstances. So you could be a professional and there could be a lender who is giving you a high LVR and waiving of LMIs,
Hmm.
or you could be an essential services operator or a doctor or a nurse or some, and there are lenders who are giving you 100% benefit of all your income, including allowances and bonuses and whatnot. So different lenders have different views, but one thing that we find quite fascinating is even the negative gearing, which is more of a tax subject, different lenders could have a different outcome. Everything remains the same, two different lenders could have absolutely different outcomes. And we have a classic example we have been working this morning. Family of two trying to buy an investment property. Lender, a tier one major lender says you can only borrow up to 300K. Another lender says I'll give you about 580. Same income, same hem, everything. So lending policies, how they do their calculations in the backdrop, actually reflects the bank's appetite or aggression towards those kind of acquisitions. So you have to be really conscious of what lending policies, and they start from specific to your profession, specific to your family income, how do they treat private tuitions, private health, etc., etc., and what do they need to see to assess your file. And that data requirement also changes based on the LVR we are talking. All lenders typically become absolutely conscious when the lending starts to go upwards or north of 90%. They want to see everything. However, because we have the magical wand of recalibrating the portfolio where possible, you can actually bring the LVR to a lower level, which means I don't have to tell the lender what I don't want to.
Hmm.
So I tell them what they need to know. Of course, no dodgy stuff, responsible lending, but I don't need to tell them, or I need to tell them what they should be asking me, rather than
Right.
giving them the whole transactions and leave them to scrutinize and audit every bit of coffee and breakfast and lunch and dinner that I've been having outside, because that makes a massive difference to your outcomes.
Right, and this is all around HEM, which is household expenditure measures, if I'm not mistaken. And is let's say someone's about to get a pre-approval, someone's about to get a loan, they want to get their next loan. Are there any really big ticket items or big rocks in the jar that perhaps like expenses is what I'm talking about, that they should perhaps just postpone a month or two, or get a friend to buy for them or something like that, just so the banks don't see it?
I think we see a lot of customers who like to hold a lot of credit cards, for example, for this. I think it's more the privilege that you have with your previous lenders. You don't necessarily use them.
Hmm.
And often they don't realize how it consumes the borrowing. Second is discretionary versus essential spend. A lot of us do a lot of discretionary spend, for example, buying a new car or anything of eh, afterpays, zip pays. We happy to use flick those cards at
Hmm.
targets and whatnot. Everything like that goes against you. Similar to
Hmm.
that, though, it's very important to maintain private health and private tuitions, but you could do transactions differently, like I said. And as long as you are within the 80% LVR, mostly banks are not interested to see your bank statements. I think one of the key thing that we recommend, keep your transactional banks different to your lending banks. This is one of the most critical, if anything could pick up, because what, like I said, what they know, they can't unsee.
Right.
If you have your savings account or transaction account, even if I do an application for you and tell them we only spend $4,000 a month, they have absolute privilege and access to your transactions.
Makes
So
sense.
it's always better to keep a veil between the lenders and your transactions.
And people might be thinking like, hey, there's like a lot of hassles, there's really intricate, a lot of technical things that I need to consider. Like, is it even worth it? But I really encourage people just to zoom out and take stock and see the forest from the trees. If you can just even borrow one more property, let's say 400, 500K property, fast forward, I don't know, whatever, 7, 10 years or whatever it is, and that thing doubles, then, that's another $500,000 that you've made just because of, yes, understanding some technicalities, maybe going through the hassle of having a separate transaction bank to your lending bank, all the things that you're talking about, Vineet. But, education is power. There's nothing that can replace this knowledge. And in the long term, it's like, why wouldn't you do that? So I think it's well worth the time, effort, and sacrifice to set all this up properly. And we alluded to at the start around the structure in which people should buy their principal place of residence. Normally, you just think, oh, yeah, it's in my own home. Just buy it under my wife's name or my name or joint or whatever the case may be. What's the case for buying it under a trust?
When you say what's the case, what do you mean? Sorry.
What's the like, why should people consider buying a principal place of residence under
Oh,
a trust?
that's one of the very counterintuitive
Yeah,
conversation that I start with my clients, and that's all about preserving your borrowing. So imagine a family that comes to me. We are currently renting. We are confused whether we buy a PPOR or an investment. Do we buy under my name or under a structure? All of that. I think the underlying theme is everything that you buy in your name consumes. So depending on your end goal, if you are happy to have only one PPOR and property is not for you, uh, more than happy for you to go ahead and buy in your name because it has its own tax implications. But if you are someone who is again in that mid income family group, you have limited borrowing, and you are in a way trying to build an investment portfolio that kind of serves you well for your retirement, then sacrificing a bit of capital gain to open up your borrowing in the right structure is kind of a no brainer if you do the maths.
yeah,
And to most of my clients, I say just think about you are talking about TPOR, which you are never going to sell in your life because that's your dream home. You're going to stay in your family. All you are either downsize when you retire or you are dead and it becomes a for your inheritors to execute the will. So it's kind of a notional gain that you're talking about or you're worrying about and consuming your borrowing. So it's a very strategic call that you have to take. But if you are in that somewhere in that mid income group and you have limited borrowing ability and you're starting your journey, this could be a food for thought. It's not for everyone, PK.
yeah. And I think you get the, if I'm not mistaken, I mean, you're the chartered accountant here, not me, but I think you get the capital gains tax, the 50%
Yeah.
discount in a
Not a
trust
tax
as
advice, you still get 50. So all you lose is just about 50.
yeah, exactly. So yeah, you do have to pay capital gains tax then if you buy it under a trust. So that's important for people to know, but you
Yes.
do get that 50% discount on the capital ta
Also, yeah.
gains tax. And of course, none of anything we're talking about today is really financial advice because we don't know people's individual
Yes.
circumstances. And then I suppose land tax is also something that would be a consideration then to buy in a trust structure because no, you have your principal place residence, it's exempt from land
Yes.
tax, especially in a place like Victoria. You know, it could add up quite a lot with the recent changes. But once again, you know, there's pros and cons of any decision you make. And if, like you're saying, if you're buying a principal place residence of, I don't know, one, two, $3 million, and you know you're buying it under your personal name versus a trust, well, you're giving up $1, $2, $3 of borrowing capacity.
Absolutely.
Whereas if you
Yes.
bought in a trust, then you could buy that many more properties, and then if they go up double or whatever the case is, then what's the cost benefit versus the land tax versus the capital gains tax? So these are all the things that people like. No one, you can't trust these types of decisions to anyone else. You need to take control, and it's fantastic people like Vineet who can provide you the right information at the right steps. But I think people need to educate themselves to manage their team and make their own decisions at the end of the day. It's a like just hearing this from you, Vineet, it's a lot of work I think that mortgage brokers do. I always say that brokers work the hardest out of any property related professional, including me. You guys are, you know, very hardworking, very diligent. How many hours, like for someone who wants to set up this trust structure, they go on to buy two, three, four, five, six, seven, eight properties. Like you're probably spending like days worth of your time on their account, right?
Yes. So I think we are as invested in a client's success as the client themselves. And like I always tell to my clients, it's not the application writing process which is critical, it's this thinking and knowledge which is super powerful. And that's where we spend lots and lots of time with banks and BDMs and whatnot to get to the right outcome for the clients. So, yes, it's a lot of effort, but I think the fruit is in the success of the clients. And we try and do things very responsibly for every client. So yes, it's an effort, but
It's
effort,
worth it all.
wealth put in kind of thing.
Got it, got it. And I think I just want to say as well, there's this it's really easy to go broker shopping, like it's like window shopping. You talk to one broker and you take 2 hours of their time and then you talk to another broker and you do that like 5 times. And from a consumer perspective, I understand why you do that because, like when you go to buy a car or whatever, you want to test drive it, you want to shop around. But at the same time, I just want to make the point that we should, as investors, we should be very respectful of mortgage brokers, especially like very strategic mortgage brokers. It's not loans.com, right? It's not, Aussie or whatever. These are like genuine experts in the ecosystem of lending, like Vineet is. And so I think we need to be very respectful of their time, knowing how much they give back and knowing that they only really get paid, as and when you purchase properties. So I think there's something to be said about the ethical side of things. Vineet, I really appreciate your time, and perhaps we should, do another session. But any last advice or any pointers from your breadth and depth of experience working with so many investors, including my clients? Any advice that you want to give lastly?
I think the advice is specific to everyone, but if you can definitely think through the structures and don't make that critical mistake that we have been making in the past because we have not been knowing what right structures is. That's absolutely powerful to make it a big success. So more like the data is very clear, PK. You know, you are the data people, and all your students are data driven. Like 90% of the Aussie families do not own more than two properties or three properties, and you can't go beyond that number if you are not in the structure. So if you really are clear on your goals and you really want property investing to work for you, you have to give a serious thought to this structure because that is super powerful in my view.
Right, brilliant. Well, thank you so much for your time. And I have to confess, like I've got a very messy structure myself. I wasn't strategic when I started off. I didn't have someone like Vineet in my corner. So like I haven't actually done this strategy myself. So I just want to say that because I don't want to be a hypocrite. But I got to 12 properties through other means and through doing developments and other things like that. So there's different strokes for different folks. Consider everyone what's right for you and understand the risks because everything comes with risks and it's all about managing those risks. Where the upside risk is lower than the downside risk, that's generally where you should take action. But everything comes with risks. And guys, as well, anyone who's watching or listening, if you want me to invite more mortgage brokers on this platform so that we can go into other dimensions of lending, borrowing, how to improve that, because property is just as much a lending or finance game as suburb selection, then leave a yes below. Leave a yes in the comments if you want me to invite more and more brokers onto the channel to discuss these topics where you can lend more, make more money. Leave a yes below. But I just want to say thank you so much, Vineet. I'm glad that I selected you from the Facebook group. And it's a real pleasure to meet you here in well, not in person, but over video.
Thank you, and likewise, I reciprocate the feelings, PK, and would love to serve your community as and when possible. Thank you.
Thanks, Vineet, and thanks everyone. Hit the subscribe button, give it a like, and leave a yes, like I said, if you want more of these conversations. My name's PK, and thank you so much for being part of this community.